Today's episode is powered by Lightyear, the investment platform offering stocks and shares ISA with zero order fees. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Gold is a terrible investment. No earnings, no dividends, and long stretches where you trail stocks and bonds. So why do serious investors still own it?
We dig into the myths, the maths, and how an asset with no cash flows can earn its keep in your portfolio. And in today's dumb question of the week, if I own a gold fund, can I actually get my hands on the bullion? All right, let's get into it. So one of the assets that people absolutely love and get almost fanatical and religious about is gold. A lot of people see it as unique and as the only real store of value long term. But if you've been listening to us for a while, you'll know there's a stat we like to trot out as a counter-argument, which is that if you adjust for inflation, gold has been in a real terms drawdown for 45 years.
Yes, that's true until now, and it's finally broken through that level. So if we did inflation adjust, the previous peak would have been $3,590 in today's dollars, and we've gone through that. And that's largely as a result of a blistering rally. I mean, it's not just a small rally, it's huge.
So gold's up something like 36% this year, and as you say, has taken it to a new real terms all-time high, with the previous one being the 21st of January 1980, where gold was $850 an ounce, which, as you say, when you adjust it to today's money, is like $3,600.
And year to date, the S&P has been beaten by gold, which is very unusual. In fact, if you go all the way back to 2020, gold has outpaced the S&P 500. And this has been a period of very strong returns for the S&P 500. So that's no mean feat.
Yeah, I couldn't believe that stat. I had to check it about 5 times before I even put it in the newsletter because, we've been in this AI-fueled equity bull market and gold's beaten it since the start of 2020. But why? Why is gold rallying so strongly now?
I think it pays to look at the biggest buyers. And often the biggest buyers are central banks, and they've been buying lots of gold. Surprisingly, Poland, the central bank in Poland, is one of the biggest purchasers. Also Azerbaijan, China, Turkey, Kazakhstan, Czech Republic, Cambodia. So all of these countries have been heavily buying gold.
I think in recent years, central banks collectively have been buying more than 1,000 tons of gold each year. Is this something they always do, though? Or have they recently decided to re-embrace gold in their reserves?
It's something they always do. Many of the central banks do favour gold as part of their reserves. And I think at the moment, because of the weaponization of the dollar, if you're not a friend of the United States, central banks have certainly been considering gold as being better than, say, treasuries, particularly for countries where they're clearly not allies of the United States. So I'm thinking here about Russia, China, or countries which are affiliated with those countries.
And you mentioned treasuries. I saw a stat that as of this year, the value of gold in central bank reserves has actually eclipsed US government bonds. And that's for 2 reasons, right? One, as we said, central banks are buying a lot of gold. But maybe more importantly, the value of bonds has fallen as rates have risen, and the value of gold has shot up.
Yeah, so what we're seeing now is that central banks have exposure to what is quite a volatile asset, but some central banks are comfortable with that and prefer it to the risk they see with treasuries, which tells you quite a bit. And there have been calls both in Germany and in Italy to repatriate their gold, which is currently held in the United States. Because if you really wanted to be safe, you don't want it to be confiscatable by what could potentially be a country which is inimical to your country.
Or I guess for them to just have that leverage over you where they could threaten it and push you to change policy.
But I think that just illustrates that at the moment, the geopolitics, certainly from the United States' point of view, are pretty much anything goes. And other countries are having to adjust to that new world.
But that would have been unthinkable in the past, right? The allies of the US would be nervous about physically holding gold on US soil. Everyone would trust the US vaults, wouldn't they?
Yeah, they would. And if you read this quote from the EMA president, that's the European Taxpayers Association, Michael Yeager says, "We're very concerned that Trump is trying to influence the independence of the Federal Reserve. And we recommend bringing back the gold of both Germany and Italy to ensure that European central banks have control over their gold reserves at all times. Shocking stuff.
I guess this is all going to fall under the banner of geopolitical tensions, of which there are many right now. And typically, uncertainty and fear about what could happen on the international stage is one reason that ordinary people flock into gold, isn't it?
Yeah, as a safety hedge, it's been pretty consistently good if you buy gold and there's a big sell-off in equity. Even during those periods when equity and bonds sold off together, which is why gold really does become useful in those periods.
But is it unusual to see what we've got right now, which is that stock markets are rallying hard at the same time as gold is surging upwards?
Yeah, that's very unusual. However, if you do look at the drivers of gold, and here I'm thinking about things like the value of the dollar, the strength of the dollar versus its trading partners, things like real interest rates, both of those are pushing gold upwards because they are big drivers of its value. So dollar weakening and a lowering of real interest rates, both of those are positive for gold, and both of those have been pushing it upwards. But in addition to that, I think it's fair to say that there's been a fair amount of euphoria and momentum buying.
Yeah, I find gold such a strange asset because, like you say, it's the ultimate safety hedge, an insurance policy for a portfolio, or at least that's how it's perceived. But it's also narrative driven and subject to wild speculation and crazy rallies itself and huge crashes, which I think people overlook with gold because it's seen as like the fear hedge.
But look, this is an asset class which comes with big risks. It's almost like it exists in two phases. A quiescent phase when it just lags for many years at a time. That 40-year drawdown's one example. And then periods during which it really peaks. And at the moment, clearly, we're seeing one of those surge periods. So I think the difficulty here is that people get drawn in by the momentum, and then just as it peaks, that's when lots of people buy, and then they get crushed on the downside.
Yeah, I mean, we started this whole episode off with a provocative kind of statement, which is that gold is a terrible investment. Now, I think it's time to address that. Why do we say that?
Well, fundamentally, it doesn't generate income. If you hold it, you lose money because you have to pay for the storage usually. And that's quite unusual. If you have a stock, it pays dividends. If you have a bond, it pays coupons. And if you hold commodities, unfortunately, you have to store them safely, particularly precious metals. Now, you do get economies of scale if you have a vault, and if your BlackRock and your iShares fund needs physical gold. Clearly, they can store it much more cheaply than you or I can. They can't just bury it in the back garden, but they can have reasonably priced storage costs. And the second consequence of not having cash flows is that you can't price it. You can't look at a discounted cash flow model because there aren't any cash flows. So there's a real problem trying to judge what it's actually worth.
And the other reason you could say it's a bad investment in isolation is that it's extremely volatile, which you typically don't want from an investment. Usually what you'd prefer is something where it's predictably going to go up over time.
So here we're thinking about cash, for example. If you invest in cash, which sounds odd, investing in cash, but historically it's been a pretty good investment when it comes to beating inflation. Because when there is a crisis with high inflation, usually cash rates pick up very quickly to accommodate that.
And when you say cash, you don't mean cash under the mattress. It has to be in a interest-bearing account.
Yeah, I mean, it could be a deposit with a bank, but all of these short-term interest rates feed off the same set of assets. These are short-term government bonds, certificates of deposit, or possibly short-term IOUs issued by companies called commercial paper. That market essentially is what these short-term interest rate products feed off. And those short-term rates adjust very quickly when you get inflation spiking. So you get exposure to them via something like a money market fund, or you could buy a portfolio of these short-term instruments yourself.
So that's one extreme of the asset landscape. Go for cash. It's not volatile at all. It should just about keep up with inflation if you hold it in the right place. But then at the other extreme, you've got stuff like stocks, which are risky and are very volatile, but over the course of history, if you're diversified, have returned enough to justify that volatility. You could argue that gold kind of isn't doing either of those things. It's volatile, but its return over the long term basically tracks inflation.
Yeah, and that's what you expect with a commodity. You wouldn't expect any kind of premium above inflation because any commodity which grows faster than inflation long term becomes unobtainable and it'll just get substituted if it can be. And anything which lags inflation will become so cheap as to be essentially free. So long term, everything tracks inflation, anything useful.
Now, before we move on to the other side of the argument, I just want to quote Warren Buffett and his views on gold. Because he's not a gold bug. He says, gold has two significant shortcomings, being neither of much use nor procreative. True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce of gold at its end. What motivates most gold purchasers is their belief that the ranks of the fearful will grow.
That's brilliant. I mean, he really cares about where his money goes and the social effects of it, doesn't he? You know, he wants it in productive assets which help society, you know, whether that's funding the government or essentially funding companies. And gold is just a fear play. That's what he says.
I mean, interestingly, I read an article a few years ago now where Warren Buffett, or Berkshire Hathaway actually, invested in gold miners, which is kind of controversial given his previous statements on gold. And he actually said at the time, I have no views as to where gold will be in the next 5 years. But the one thing I can tell you is it won't do anything between now and then except look at you.
If it's in a vault, it's not going to look at you.
Yeah, I think he just thought the miners are underpriced. I'm not an ideologue. I'll buy anything underpriced.
But I guess that's an important point, which is that if you do buy the miners, you get access to the risk premium that's in those stocks. And they do tend to be high dividend payers. And of course, they get exposure, indirect exposure to the price of gold. So it was an interesting play. I did a similar thing for copper.
Let's hope you don't get a 45-year drawdown there, Roman.
No, I'm sure we'll be fine.
But to go back to gold, and to summarize, why might it be a terrible investment in isolation? No cash flows, volatile, costly to hold. But a weird thing happens when you mix in a little bit of gold into your portfolio. That asset, which in isolation looks unattractive, might actually improve the overall performance of your portfolio.
Yeah, I mean, this is what made me come round to gold. We had that long chat with Tyler, the creator of Portfolio Charts, and that was on this podcast. And it was really interesting. I've very slowly come round to the idea that gold actually, as a part of a portfolio, certainly in drawdown, when you've retired already, makes sense. And that's because of this combination effect. And the metaphor he uses, that Tyler uses, is one of cooking. If you eat salt on its own, it's absolutely insipid. But if you combine it with other ingredients, it can transform a dish. And I think that's a good metaphor for how gold works, how it affects the risk of a portfolio, but also its return.
Yeah, he's done some great work where he's modeled various portfolios with different asset allocations and sort of replayed history and how they would have performed. And if you look at it on a risk-adjusted basis, so you're taking account of return and volatility, the thing that's common to basically all the portfolios that top the table is that they have some element of gold, usually somewhere between 10 and even 30%, which seems pretty high.
And it's important to understand what he was looking at. He was looking at safe withdrawal rates, which is the amount you can withdraw in year one of your retirement. And then every year after that, you'd inflation adjust what your withdrawal was. And he did lots of back tests across multiple countries. And the safe withdrawal rate is the one that would never have run out of money over a 30-year period. So it is a very, very cautious approach. The metric he used naturally tilts it towards being very cautious and focusing on those awful, absolutely awful 30-year periods.
And in those 30-year periods, the thing that saves you is the gold, at least when you look back in history.
Today's episode is sponsored by Lightyear, the investment app built for a great user experience available on both web and mobile. They've just made their stocks and shares ISA completely commission-free, so you can invest in over 6,000 stocks and ETFs without trading fees eating into your returns. Fund manager fees and a 0.35% FX fee may still apply. You can also transfer your ISA in or out at any time, giving you extra flexibility to manage your money the way you want. You can try Lightyear using the code PensionCraft or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. Remember that investing involves risk, and the value of your investments can go down as well as up. So why is it that during these atrocious periods when essentially the whole ecosystem of finance is collapsing, why is it that gold saves your bacon in those kind of environments? Well, the thing is that gold isn't to do with a single country. It's an international asset. So even if your country's stuffed, even if large chunks of the economy are stuffed, people still like gold and the safety it provides because it's been around for so long as a desirable commodity for humans that it's got this place in our psyche, if you like, as being something dependable. So when everything else fails, gold is what people go for.
And to put that in technical terms, you could say that gold has a low or even negative correlation to equities, especially in crises.
But this is an interesting point because correlation is an odd thing to measure because you have to make an assumption about the period of time over which you look at the correlation. So, for example, if you look at daily returns and look at the correlation of stocks and gold, what you'll see is that actually there are periods when there is fairly high correlation. The two move in the same way. We're seeing that right now. Then you get periods when there's negative correlation during a crisis, and that's the really important one. So I think having this long-term correlation view is the one that's more important when it comes to these crash hedges and essentially disaster hedges.
And I think it's important to see gold in those terms. It's a tail risk hedge or insurance for your portfolio, right? You don't want too much of it because the other thing the data showed Tyler was that of all the thousands of portfolios he looked at, the worst one was 100% gold.
And the surprising thing was that the best one was cash. If you just hold cash, it's actually not a bad investment.
The best single asset, yeah.
Yeah, exactly. So single asset, worst one was gold, and the best one was cash.
And to just reiterate, we're talking about the worst case scenario. Because you might say, well, surely stocks is the best asset. But not if you're looking at the disaster 30-year period where you're drawing a lot from your portfolio every year. You can exhaust it quick.
Yeah, and here we're talking about safe withdrawal rate. So if you go for something that's ultra cautious, yeah, that's going to be cash.
Now, the other thing people say about gold, which is quite controversial, is that it's a good inflation hedge. And we've sort of hinted at that, haven't we, earlier on, where we said long-term gold seems to keep up with inflation, which is basically what you'd expect a commodity to do. But we don't always care about the long term, do we, if we're putting our portfolio together? Sometimes you get a sharp inflation spike, and you want something to hedge that in the short term. Now, this is where you can debate whether gold is a good inflation hedge or not.
Yeah, I mean, the numbers here just don't stack up. If you just look at the correlation of gold and inflation, and here, if you look over short periods of time, you can't really do that because inflation moves quite slowly. And over the longer periods of time, yeah, it tracks it over very, very long periods of time. But if you look over, say, 1 year periods, during periods of high inflation, gold doesn't necessarily rally. And during periods of low inflation, it doesn't necessarily fall. So the numbers just don't work.
The thing I was thinking about, though, Roman, is that we've said there are occasionally periods where stocks and bonds both crash together, and gold typically is the asset that's going to save you there. And the situation where that happens and stocks and bonds fall together is usually an unexpected large spike in inflation.
Yeah, I guess what I'm saying is that if it's just inflation on its own, and is kind of slightly toppy, then there you don't get the correlation. And if it's kind of lower than its long-term average, there you don't get much reduction in the return of gold. It's the shock periods when it becomes really useful, when you get these really short-term spikes. Often it's due to war in the Middle East, an energy shock. In COVID, it was due to supply chain issues. But whatever the cause of that short, sharp shock with inflation, that's when historically gold has held up pretty well. And bonds and stocks didn't, of course. So I think correlation is misleading here. I think what's really important is how it behaves in crises. And usually if you make a risk system for an investment bank, you'll have two completely separate analyses. One will look at these kind of daily correlations, and another one will look at these shock scenarios where you replay these awful events of the past. So doing these shock scenarios, I think that's when gold really shines.
I mean, I guess that's what you want. If you're holding it explicitly as a kind of insurance for your portfolio, what you care about is how it performs in a shock. It's not there to drive long-term return. Maybe the other thing to say is if you are including it in a portfolio in that sort of 10 to 20% range, rebalancing becomes critical, both because you don't want your insurance to become too big a part of your portfolio if gold is rallying, but also you don't want it to become too small a part if gold is in a long drawdown and the risk assets are rallying. And in fact, the very act of rebalancing itself can boost performance. There's this kind of rebalancing premium, which improves risk-adjusted returns.
Yeah, it's not huge. I think that's important to stress. You shouldn't expect rebalancing to help you a lot. But look, what you're doing is you're buying the thing which is lagging the rest of the portfolio. You're selling the thing which is outperformed. If that trend continues, of course, rebalancing will be a problem. But these kind of long-term trends don't persist forever. So in kind of choppy markets where you're passing the baton of return leadership from one asset class to the other, that's when rebalancing helps you. But usually it's best to do it, once a year on some kind of fairly infrequent schedule, or combine that schedule with bands of how much you want it to deviate from your long-term weights. That's usually the best approach.
I imagine there are some disciplined investors rebalancing right now, given how strongly gold's rallied. Which kind of leads me on to another provocative question, which is, if you're holding gold as a tail risk hedge, will it perform that function now it's rallied so hard? Like, we know equity markets, especially in the US, are arguably overvalued. Certainly they look very expensive. Let's say we got a big crash, 30%, 40% stock market crash. Is gold going to do the thing it's usually done in the past, when it's going into that potential crash looking very expensive itself?
Yeah, I think that's a good point. Is it going to be part of the sell-off this time around? Because it seems as if every accepted wisdom about investing has now been essentially shattered over the course of my life. So why not shatter one of those beliefs again? I wouldn't be surprised, given the size of the rally. And if you look at the long-term price action of gold, all you see are these massive peaks and massive crashes, which is really quite worrying given what the price of gold looks like today.
But you said we can't value it. So when we say it's expensive, what do we mean? Does it even mean anything to say that about gold?
I think I wouldn't trust a valuation model for gold. That's not to say I hadn't made one.
I was going to say, don't trust it. There's one on PensionCraft.com.
But look, all models you shouldn't trust. It's just a matter of looking at what the usual drivers are of an asset class and how much of the return they can explain. And whatever's left must be due to euphoria, or at least other factors. So what we've done with this model, it's really simple. It looks at inflation. So that's one of the things that goes into it. That gets the long-term trend. I use US inflation for that, CPI inflation. It also has real yields. So US 10-year real yield. If yield is high, gold is a wasting asset, so it becomes less attractive. And the final factor is the strength of the dollar. It's measured in dollars, the price of gold. So weak dollar means strong gold. So taking those three factors into account, currently, gold is overvalued by around 16% as we record this podcast.
So what's explaining that gap then?
Well, it's something else. That's all we really know. It could be euphoria. It could be momentum trades. It could be geopolitical factors, which the model doesn't know about.
Just a structural change in the market, I guess, if central banks are accelerating gold purchases because they're scared of weaponization of the dollar.
Yeah, I mean, if you look at the Gold Council, they've got a slightly fancier model, and that takes into account supply and demand factors. But I think that too is showing that it's overpriced.
And is this unique to gold, or are other precious metals in that same situation?
Well, we have a silver model which uses the same inputs as this gold model, but with slightly different coefficients, which does a pretty good job of explaining the historic movements of silver. That also shows that it's currently overpriced. It's had a huge rally, just like gold has. Sometimes people describe it as a poor man's gold. But the big difference, I think, is that silver has industrial uses, lots of them. particularly in things like solar panels, which has created a big increase in demand for silver.
I mean, gold has some industrial uses, right? And I presume it would have many more if it wasn't so bloody expensive.
Yeah, I think only about 6% of the demand for gold is industrial uses. The rest is just because it's shiny. But look, there are cultural reasons as well. If you live in India, for example, and you're thinking about your daughter's marriage, well, you better save up lots of gold.
But is all this like an accident of history? Is it like Harry Potter? Yeah, the books are fine. Somehow it became the biggest thing in the world. No one knows why. Or is gold actually a unique material?
Well, it has many special properties. If you're trying to create money, what attributes would that have to have? Well, firstly, it has to be something which is durable. And gold, of course, keeps its luster because it's got low reactivity because of its physical structure. It's also got to be divisible. You've got to be able to chop it up into smaller bits so that you can have finer units of measurement. It's got to be fairly scarce, otherwise everyone could make it. And it's got to be desirable, intrinsically desirable. And I think gold is, because it's got that nice shiny yellow colour.
Yeah, and I guess it's quite malleable, so you can stamp it and make it look official.
Yeah, and it's got all of those properties. So historically, it had a lot going for it to be used for coinage.
I mean, that's what gold bugs say, isn't it? It's the original store of value, 5,000-year history. It's not going to end now.
Yeah, I think that's good as far as it goes. I wouldn't say that it couldn't potentially collapse in value if we increase the supply of gold. And there are various reasons why that might happen in the future. But certainly at the moment, until that happens, then I don't see any reason why it would become less desirable psychologically.
Yeah, I agree with that. But I think some people go too far when they say it's like the only form of real money and stuff like that. I don't believe that.
Oh, yeah. I mean, when I first made videos about gold, this was really before the crypto craze really took off. The gold bugs that would reply to my videos were almost identical to the ones from crypto nowadays, which is you don't know what you're talking about, you haven't studied what gold is. Crypto people say exactly the same stuff. When it becomes like a religion, then you know you're in trouble.
But I'm interested in what you said a minute ago, which is that you could conceive of a way to boost supply so much that gold becomes a lot less valuable. What are you thinking about there? Is this science fiction or actually something that could happen?
Well, I think there are a couple of reasons why gold supply could increase dramatically. I think if we did do asteroid mining, it's possible that we could find asteroids with a lot of gold in.
I think we found some, haven't we? We just can't haul it back to Earth yet.
But if that becomes feasible with AI and SpaceX and reusable rockets, if it suddenly becomes possible to get hold of that gold, then that could increase the supply massively. Because it's important to remember that all of the gold ever mined is not that large.
3.5 Olympic swimming pools is what I read.
Yeah, let's roll out some nice visual metaphors for a podcast. If it was a cube, just one cube of gold, all the gold ever mined, it would be about 22 meters on a side, 60 foot by 60 foot by 60 foot. Alternatively, 35 London buses.
If only they weren't on strike. Now let's go back to this asteroid. It's called 16 Psyche. It's around 140 miles wide, and NASA believes it contains a core of iron, nickel, and gold worth $10,000 quadrillion. The trouble is, if we hauled that back into Earth, I don't think it's worth that much, is it?
I don't think it's proven. Imagine if you got there and it just had nickel in it, you'd be really upset after going all that way.
If I had a nickel for every golden asteroid, I'd mind.
Oh, Michael. Very good.
But is that the only existential risk to the gold market? Space rocks?
Well, no. And there's a bit of physics here, which I'm very keen on. So if you actually look at the structure of the nucleus of gold, it's got 79 protons in it. So it has 79 electrons on the outside, which give it its chemical properties. If you look at mercury, that's got 80 protons in it. So one way to turn mercury into gold, here we're talking about alchemy, what you do is you just bombard it with neutrons. And then what happens is that it decays into gold. It's a specific isotope of mercury that you have to use. But if you take a fusion reactor, which spits out lots of neutrons, put mercury around the cladding, then you get quite a good conversion rate into gold. So for every watt of energy that you generate a certain amount of gold as a byproduct. It is radioactive gold. You have to set it aside for maybe 10 years to stop being radioactive, but gold nonetheless.
Look at this headline in The Guardian this morning. UK and US line up string of deals to build modular nuclear reactors in Britain. We're going to be rich, Romin.
We're going to have our own gold rush. I can't believe it. I'll tell you what, Michael, we could just sneak in our little buckets of mercury and just set them next to the reactor. And that way we could generate our own gold. What do you think?
What a heist movie. Stealing the neutrons. But is this science fiction or could this really work? You're the physicist here.
Yeah, the physics is sound. There's no question. I mean, that's how it was created in the first place. You have to have super dense material and lots of neutrons flopping about. We used to think that happened in supernovas when stars died. Now we think it's when neutron stars collide.
But then people keep saying nuclear fusion is going to happen. Like this article in The Guardian, we're going to build some fusion reactors. Should you genuinely be concerned if you own gold? Or do we now need a tail risk hedge for our tail risk hedge?
I think it's a worry, and I think it's something that is feasible. So it's something you certainly should be aware of. It'll take a while. I mean, we'll probably see news stories about it far before it actually starts to become commercial.
But markets are forward-looking. By the time it's in the press, it's in the price, no?
Absolutely. So I think that could drive a crash in the price of gold, and it's likely to.
Really, though, it seems like science fiction to me still. I can't envisage gold being driven down in price by nuclear reactors. Is there any precedent for this, like a valuable asset suddenly becoming almost worthless?
Well, the obvious one is diamonds, right? Because now we can make them industrially to very high quality. What's interesting in that market is that there is a kind of cachet for diamonds which have been dug out of the ground rather than ones which are made in a factory.
If no one's died for it, is it even a diamond? But no, right, why is there this snobbery around lab-grown diamonds?
Why do people want diamonds in the first place? I've always found that kind of surprising. But I think another reason why gold might lose value is because something like crypto is seen as a substitute for gold. I remember when the price of gold was lagging what our model was saying. It was a fairly extended period when that happened. Many people thought it was because people were buying crypto instead as a kind of gold substitute, which is kind of crazy because it behaves completely differently to gold.
Yeah, that was like 2021, I think, when everyone was saying Bitcoin is eating gold's lunch. But it's conceivable that it could, or another asset could come along which fulfills that function. It just won't have the 5,000-year history, which is kind of needed, I think.
Yeah, I think for a tail hedge, having that kind of pedigree really helps.
But at the moment, gold is not really behaving like a tail hedge. It's delivering returns, stronger returns than equity markets, which I imagine is drawing more money into the asset. But the question always, when you see a strong rally, is, can it continue?
I think one of the prime drivers is the person who's currently president. So while he stays in office, I think that'll provide a tailwind for gold. And I think a lot of the concerns that we've got about the global economy right now are to do with this shift in patterns of trade, geopolitics, just political norms. And when people are scared and discombobulated, that gives a bid to gold. So once this presidency ends, if it ends, then I think that could potentially be a point at which gold could weaken. If we do go back to a world which has more certainty in it. Although now that the populist genie's out of the bottle, I'm not sure that's going to happen.
So you're putting all the blame on Trump for this gold rally?
Well, he's the right colour. Are you a gold bug, or would you like to have a second opinion and see what other people are doing when we have one of these blistering rallies in precious metals? If so, why not get the Vox Pop from our community? Just go to pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week is, if I own a gold fund, can I actually get my hands on the bullion?
Now, I thought the answer until today, I thought the answer was no. Am I right, Michael?
No. Who changed your mind on that?
It was you.
I mean, I think the answer is usually no, you can't get your hands on the gold that underpins an ETF, for example. But sometimes, yes, there are some specific gold funds where normal investors can redeem it for a gold coin or a gold bar in a vault.
Now, that's not to say that an exchange-traded product, these are actually called ETCs because they're exchange-traded commodities. That's not to say that those funds don't actually buy and sell physical gold. They do. If it's physically replicated, when you buy a bit of the fund, they'll go out and buy a little bit of gold, which goes into a vault somewhere. Some people choose the vault to be local because what they don't want is for it to be on the other side of the world and subject to geopolitical risk. So that's another consideration. And then when you buy that fund, it's not actually the fund manager that does the creation and redemption process, it's the authorized participants of the fund. But yes, you can think of these ETCs as like trading chits, which effectively give you the value of the gold without being able to trade it in for the gold. It was similar with pound notes. If you had a pound, then you could have traded it in for silver. I mean, that's why it's called sterling, right? That was true in Anglo-Saxon England from the 8th to the 11th centuries, for the Middle Ages to the Tudor period. And then in the 1700s, we shifted to a gold standard. But then after about 1816, it was no longer convertible to metals. So you can't do that anymore. But it was interesting that you said you can do that with one of these funds.
Yeah, it depends on the fund. So for the biggest gold funds in the world, only the authorized participants can redeem their shares for gold bars, and they can only do it in large sizes. But there are some ETCs which make a big deal of the fact that you, ordinary Joe Bloggs, can go and get a gold bar in exchange for your shares if you have enough. So one such fund is the Physical Gold ETC from the Royal Mint. It has the ticker RMAU and was launched in partnership with Han ETF. And on their website, it says investors can redeem their ETC securities for physical gold from the Royal Mint in the form of a range of gold bars and coins. And it's not just theoretical, people have actually done it.
But it has to be said, it's not a simple process. So, for example, if we do dig into the prospectus for the fund, if you're a non-authorized participant, which is a normal person rather than an investment bank, you have to submit a redemption form. You also have to have something called a security holder metal account into which the relevant metal can be deposited. And they have to do KYC requirements, know your customer requirement, in order to agree to the transfer. And you have to pay a redemption fee. I'm not sure what that would be. But I see that someone actually did this in 2023.
Yeah, people have done it. But like you say, it's complicated. And there are fees, there are metal agent deductions. But I guess if you go through it all, in the end, there will be a vault with a gold bar with your name on it. But the reason I guess people would be tempted by these funds is if they somehow doubted the security of quote unquote paper gold. The criticism often of these physically backed funds that own gold is that you don't really own the gold. But then these are saying, well, you do. And here you can get the gold if you must. But in a situation where the world's collapsing and you want to get your hands on your gold, are you going to be able to get to that vault? Is this redemption process going to work? Like, what's it actually giving you?
Or are you going to get mugged on the street when you leave the bank? Yeah, I think it's a real odd situation in which you'd need physical gold.
I wonder if it's just a marketing point to say, look, you can do this, therefore you should trust us that the gold is there.
With the full knowledge that very few people are ever going to do it. Yeah, I think that's right. Personally, I couldn't care less whether it's going to be something I can redeem.
There are similar funds in the US, Vanek Merck Gold ETF and Sprott Physical Gold Trust, which I believe do allow physical redemption from ordinary investors too.
But there are reasons, tax reasons, why some people choose to buy physical gold. And in the UK, for example, some forms of gold become money. So it has to be created by the Royal Mint and it has to be specific coinage. So in the UK, we have sovereigns and Britannias. Now, you don't pay capital gains tax on these because it's just money.
But if you want to store them securely, there's going to be a cost involved. Or you can just bury them in the garden and hope for the best.
Yeah, and there's always a question of how easy they'd be to sell, and would there be a ready market for it in a crisis?
But are some people holding it not for its crisis potential, but just because it's a tax-efficient way to hold gold?
And it's nice to physically hold your wealth. I always imagine that would be kind of interesting. It always seems very almost theoretical when you look at your portfolio value and see whatever you've got. But if you can hold it in your hand, that must be quite impressive, I think.
Or just really underwhelming if you've spent all this time accumulating wealth and then it's like, just fits in the palm of my hand, that's it. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.